Tim, how's it going?
It's going well, Aaron. How are you?
Oh, we have the big trip to Indianapolis next week, so just
Yes, we
getting
do.
pumped for that. It's that the off season. I think a lot of people always say after tax season it must be nice. It's like no, because you're just prepping for the next tax season. It's the off season's the busy season too.
Yeah, the wives figure it out pretty quick. There is no such thing as an off season.
Yeah. There's 2 weeks where you don't see us, and then there's 50 weeks that are busy.
Right.
Well, a couple holidays. Give yourself a couple weeks then.
Yeah.
Awesome. Well, we've got a super exciting discussion today about entity selection, tax entity versus legal entity. This is a big thing that a lot of people are asking questions about with us, or we hear it a lot, at least, right, Tim?
Right.
Yeah.
Yep. And you always get the opinion of a lawyer, which they get the legal side of it. We want to come at it from the perspective of the tax side.
Exactly, because they're related, but they're also completely separate, right? Which we'll dive into here shortly. But I think that's a common thing that I hear from people is, oh yeah, no, I registered my business, and it's just a name that they registered. It's like, well, you got to do more than that. Or hey, I'm an LLC, so I'm an S corp, right? It's like there's some more work that goes into it.
Right.
So,
yep.
We'll clear that up, and then obviously our favorite discussion is reasonable compensation for those S corps. But without further ado, let us get into our presentation today. So as we said, we're going to do a deep dive on entity selection and reasonable compensation in S corps, and I couldn't quite fit everything in the subtitle, but we're going to go over a little bit more than that. We're going to start talking that legal entity versus tax entity, define what we're talking about. Let's start there. Then we'll go into the tax entities, the different ones, and then that's really going to be our discussion of which one's right for you. So depending on your situation that you're in, there's going to be different tax entities that make more or less sense. And then we'll talk about S corp elections, because a little spoiler on that tax entity discussion, S corporations are the most common form of small business. So we'll be chatting about that. And lastly, reasonable compensation for those S corp once you make that S corp election. As always, if you have any questions, comment them below. We'll get your feed in here, as well as you can shoot us an email. We'll answer any questions that pop up after each section, and then we have an open Q&A at the end where we take any questions, not just stuff related to the topic. Awesome. Let's dive in here then. So, legal versus tax entities. As I already said, they are different. They are somewhat related. Really, the biggest thing is the legal entity that you create is going to create a default entity for your tax. But that doesn't mean that, your legal entity solidifies exactly how you can be taxed. There's elections you can make. There's some flexibility. The biggest thing from a legal entity standpoint, and it's why Tim and I said, hey, talk to an attorney. You're going to form it at a state level, and it's going to determine your liability protection. And that comes to, your assets, your finances. There's a lot of reasons to create legal entities, not all of them for tax. That's going to be the stuff we don't want to talk about because I'm not, that's not our area of expertise. But the ultimate point is your legal entity is not dependent on your tax entity. Now, you want to take into account the tax effect of your decision before you pick your legal entity, but it's not dependent on taxes at all. And really, again, it's that liability protection. It's your contracts, your licensing, stuff like that. That's where legal entities are going to be more important. For example, Tim, you and I, from a legal standpoint, we have to be incorporated. We can't be operating as an LLC as an accounting firm. That's just an Oregon regulation. So we have to be incorporated. Not everyone has to. Again, it's really more about those liabilities. The tax entity, you're creating that when you register for your EIN. Again, that is going to be dependent on what legal entity you have. It's more used to determine your tax treatment, and it really just says, hey, how are you being taxed, and at what rate are you being taxed? So,
and really quick, just to jump in on the on the liability protection, regardless, and we tell this to all of our clients because a lot of our clients will come to us and say, hey, I set up a new LLC. And, oh, okay, well, it's a little bit late to be talking to us, but when you're talking about liability protection, the main thing that you're going to need is insurance coverage. So a lot of these legal entities don't really offer you the full legal protection that you're really looking for. It's just the insurance coverage that you have for your business. So keep that in mind when you are talking to a lawyer about the liability protection and the legal entity side of things.
Yeah.
You want to make sure that you're always covered with enough insurance coverage.
I'm going to briefly mention it. I'll punt. It's not in this. A lot of people, they will, hey, I'm going to set this stuff up, but then I'm not going to follow the rules. And the government is going to sit there and say, hey, if it walks like a duck and it talks like a duck, it's a duck. I don't care if you wrote a piece of paper down that says it's a bear. If it walks and talks like a duck, it's a duck. And that's a pretty common thing we've seen. But as a quick summary, there's different forms, but sole proprietor, partnership, LLC, corporations. For the most part, it's gonna be one or more owners, unless you're a sole proprietor, as you might guess. And a partnership has to have two or more, right? You can't have a partnership with one person. Sole proprietor, really, we'll dive into it later. It's essentially like an assumed business name. We're keeping it really simple. So if you notice, it's like there's no liability protection. The tax treatment is going to be one of the worst, and it's really informal. And really, that's where the IRS likes to pick on the most, those Schedule Cs, right?
Yeah, a lot of well, because most of the time it's self-preparers, right? Well, I'm so small that I don't really need any entity set up. I just want to operate. And so then people will self-prepare, and the IRS knows it, the state knows it, and they come after those Schedule Cs. Really, that sole proprietor is meant for little to no income, one person, borderline hobby.
Yep. Yeah, the next slide is going to be probably more of the meat of what I want to talk about, but LLC is where most people fall, right? We're going to see some corporations, and there's some things to take into account, but corporations are just a little more formal. LLC, I always say that it's when in doubt, set up an LLC. Make it really quick, simple. It gives you the most flexibility. It's not as formal as a corporation. It's a little bit less effort, but looking at that, as we were just saying, doing business as, if you do a DBA and ABN, by default, you're going to be a sole proprietor. Schedule C, that's what we're talking about. Same with the single member LLCs, and that's what we hear a lot is like, well, I set up my LLC, I'm an S corp.
Right.
No, because by default, you're a sole proprietor. You got to do the other paperwork to become an S corp. Multi-member LLCs, if you notice, LLC, the big difference here is single member versus if you have multiple members, right? It's just, again, by default, what are you? By default, you can't be a sole proprietor with multiple members. You're going to be a partnership. And again, corporations are always going to default to a C corp. And that's the big delineation in legal formations is everything else is going to be set up as self-employed for the most part, right? Sole proprietor, partnership, those are self-employed entities from a tax standpoint. If you set up as a corporation, you're by default going to be taxed as a corporation. And we'll talk about what that means a little bit later. Tim, do you want to talk about sole proprietorships?
Well, I dived into it a little bit, but to get into it a bit more, really, the IRS has everything structured so that you can start your business, and a sole proprietor is perfect for someone who isn't really sure what's going to be the next 5 to 10 years of their career and what their business is going to do. You can open a sole proprietorship and close a sole proprietorship very easily. It either shows up on Schedule C 1 year or it doesn't. There is no other legal filing requirements outside of if you have income from whatever line of work that it is you're receiving income on, you report your income and expenses on Schedule C. If you don't in a year, you just don't report it. It makes it extremely easy. That's where we say, if you have low to no income and it's up in the air what the future is for this business endeavor, sole proprietorship is great. But from a tax perspective, every dime of income that you earn, the net income, so all your money comes in, that's your gross, all your expenses go out, you're left with your net. We want to keep that net income very low on a Schedule C, because every dime of it is subject to self-employment tax, and that can get hefty. Even at 50K net, we tell people to move away from being a sole proprietor.
Exactly. Yeah. And I think what you said at the beginning, it's when you start up and you're not sure. Because I mean, plenty of people get 1099s, and those are going to, again, by default, even if you don't have a sole proprietor set up, it's going to be on Schedule C. It's really just a catch-all for people who haven't set up entities and taken tax strategies and taken the legal protections. But to that point, let's talk about self-employment tax, and it'll be an important topic going forward. The big thing that the IRS is trying to capture there is, hey, when you have a W-2 job, you're going to be getting taxed on payroll taxes. You're paying your FICA, you're paying your Medicare, you're paying your Social Security. And the business is going to be paying the other half of that, right? It's split 50-50 between individual and the business. Well, if you're self-employed, you're not getting a W-2. I mean, you can get a W-2 at the same time, but that's how the IRS is going to look at it is, hey, you're getting wages that aren't on a W-2. And as a company, you're not, paying yourself because there's no payroll. You cannot run payroll for yourself. You're not paying that on the company side. So what do? They give you self-employment tax. It's just the business and individual portion of FICA Medicare. It's like 12.5%. But it can be, that's a fat tax on top of the income tax that you're already paying, right? And that's where it starts to make sense to do those other entities, because you're paying that self-employment tax. And that's for all self-employment entities. We'll be referencing that again. That's what self-employment tax is. Obviously, it's a huge strategy if you can eliminate that in any way, shape, or form. The other thing I wanted to add about sole proprietorships is you'll see a lot. There's a lot of variation in the businesses, right, Tim? Like we've worked with car dealers that are a Schedule C. I've dealt with, someone, small hobby business on a schedule. I mean, technically,
Barbers,
yeah, people running stuff through Turo. It's a bit large. Again, it's that catch-all if you haven't elected to do something else. So it's a very common one. But again, we try to avoid doing those as much as possible.
Right.
Partnerships, very similar to self-employment, but there's a few reasons, right, that we'd want to do a partnership. I mean, I think for anyone, I almost never advise being a true sole proprietor. I say, hey, set up an LLC. Let's have the options to elect into something else. Right. But a partnership, there's situations where you want to be a partnership. It's subject to self-employment. It's, again, that one of the big things, and I see this mistake made very often. No owner should be on payroll in a partnership. It happens all the time. It's called a guaranteed payment when you do a partnership. But again, the partnership has the self-employment tax, so it's not tax preferential like an S corp is. But Tim, I'll let you talk about real estate, because I know that's a big portion of what we see partnerships for. The other one is it's really common with like attorneys and accountants specifically, just because it can be super flexible. So, a lot of traditional accounting firms and law firms, they want to pay the owners out based on, what they produced that year and their billable hours. So they want that flexibility to, hey, we want to, allocate the profit and loss differently this year than we did before. We want to do some guaranteed payments. This person's going to, there's another strategy I've seen where, hey, they're going to be 100% a capital partner and they get 50% of the profit. But if the business runs a loss, they actually don't get to take any of those losses, and one of the other partners wants to take it. So you have a lot of flexibility, and that's what's appealing about it. That's why you see it with a lot of accountants and attorneys, because they just want to, they want to have a little bit more control on a year-to-year basis, who gets what income, who gets taxed on it. And again, that cost is going to be your self-employment tax.
Right. Yep. Yep. No, yeah. Partnerships, every dime of net income is subject to self-employment tax, just like a sole proprietor. But exactly what you said, partnerships are extremely flexible. So, but what also correlates with sole proprietors is that you want low to no income on these tax returns. If you do have high income and you stay a partnership, it's because, like you said, you want the flexibility of giving profit to this person, this much capital of ownership to this person because they put in an extra good amount of money, whatever. You have complete flexibility in a partnership for ownership structure and allocation percentages. But most of the time, you're going to see a partnership showing low to no income, if not a loss. And that's where you were talking about real estate. Real estate, the IRS is expecting a loss on these partnership returns. And so
Especially at the beginning.
Especially at the beginning. And so you can use, especially in a multi-member LLC, you open as a partnership and you invest a lot of money into the business to get it going. You drive a heavy loss. And then when it makes sense, you can make an election to a different tax entity to be taxed more favorably, which we'll dive into. But to start out, the IRS and the state are expecting low to no income, if not losses, especially on real estate. And so that's where we've had a lot of success with putting all of our real estate clients into partnerships and holding those appreciating assets within that tax entity.
Well, exactly. Then to your point with the liability protection from earlier is if it's in a partnership too, they audit the partnership. They don't get it by default audit your personal. That's another big reason that a lot of people will do the partnership return is just get that little bit of audit protection, which is also why partnerships are audited at a much lower rate than 1040s. You know, that's just a fact. You know, again, the IRS really likes to pick on those Schedule C's, Schedule E's, anything on the 1040 because it's low hanging fruit for them. It's easy. The one thing I did want to chat about, because the one exception to the self-employment is obviously if you have a self-employment, if you're self-employed. Partnerships it's very common to have passive activity, which is what real estate generally is going to be, unless you're unless you're a real estate professional and you really are trying to drive those losses. So that's how you don't have to pay self-employment tax, even when your rentals do start to turn. Because at a certain point, you're not going to be able to claim losses forever, right? Appreciation, the rent value is going up. You know, you like to show a loss for as long as you can. If you're doing it right, at some point, you're going to be showing a profit. But the biggest reason people use partnerships for real estate is it's the only avenue where you can distribute property from an entity at your basis from the entity. What that means is, hey, let's say that you dissolve the partnership, you can grab that building that you put in the partnership, pull it to yourself personally. Like, let's say you and I were on a building, Tim, and for some reason I wanted, we were going to dissolve the partnership and the building was going to be mine. I can grab that out of the partnership tax-free because that distribution is at my basis. We'll talk about the other entities. In corporations, those distributions are always at fair market value. So something like real estate that's an appreciating asset, you put that in a corporation, you try to get that back out, you're going to be paying a lot of taxes on it, which is why, again, the partnerships, the most common use that we see is real estate.
Right.
S corps, again, most common. There's some rules. You can only 1 to 100 owners. You can only have one class of stock. That's where what we were talking about a little bit earlier, right? There's less flexibility. If Tim and you and I are 50% partners in this, or I guess owners, because we're not partnership in our S corp of the accounting business. When I take out $1, you have to take out $1. I can't say, hey, I've had a really productive year. I want to take out $5, and I don't know why we're doing $5 distributions to begin with, but we got to be. There's the only way to balance those out is we have to bump up payroll. That's the only area where you can play with making that a little bit more even. And so that's the one of the big things about S corps. It is restricted. That's where you see a lot of single member S corps. Husband wife, because at that point you have unlimited gifting between the two. The distributions don't matter. You see a lot of the smaller S corps, and again, because they're meant for 100 or less. They're small businesses. They're not these multinational companies like Nike, which we will get to in a second. The biggest reason people do this, they're not subject to self-employment. And again, that's because sole proprietor, partnership, you cannot take payroll. As an S corp, you have to, because they want to collect. That's the big thing, is they know they're not getting that self-employment tax. IRS wants to collect on that, self-employment tax. So they're going to make you run payroll to get it.
Yep.
And as I was saying, kind of with the partnerships, distributions are at fair market value. So do not, we could make a half-hour discussion about this. Do not put appreciating assets in any sort of corporation. You will be taxed heavily when you try to withdraw it.
Yep. No, and S corps are the most common tax entity that we work with, and that's because when you are forced to take payroll, it's because of that Social Security and Medicare that the IRS and state are no longer getting now that you're an S corp. So the payroll is their way to still get it, right? So they still want that piece of the pie from you, and they're going to force you to give it to them through payroll. But what is reasonable, Aaron? What is reasonable for compensation?
We'll get to that in a bit. I got a whole section. All right, C corps. These are infinite shareholders. Again, it's that really formal setup that we're talking about. Think about Nike. Think about any other company that is publicly traded. Just Nike's in our backyard, so you hear me referencing it all the time. Anything that's publicly traded is going to be a C. Well, for the most part, it's going to be a C corp. They do have publicly traded partnerships. So that's really niche. Let's not get into it. These are going to be for very large businesses. I think it used to be a bigger strategy way back in the day for small business, but we haven't really talked about pass-through entities yet. So I want to take a minute, chat about those. Pass-through entities, sole proprietor, S corp, partnership. You are taxed on how much the business makes, not how much you pull out. That is a hugely misconceived point. It doesn't matter if you only take $50,000 from the business. If the business made 70, you're getting taxed on 70, because the business does not pay tax other than some weird, local specific taxes. Income tax is taxed at the individual level. That income passes through the business to you personally. So you pay the income tax related to those businesses. C corps are going to be paying taxes on their profit at an entity level. That federal tax rate is 21%. And then if you take anything out of a C corp, there's only two ways to do it. You can do loans and stuff, but I'm not going to get there. It's really payroll and dividends. Payroll, you're obviously going to be paying income tax on it personally. It's a deduction to the business, but you're also paying that payroll tax. And then you can also get it out via dividends. And that's where some really large corporations, you're making over $1 million, you're capping out your tax brackets. There's some strategies to be had with dividends, but that's not most people. And there's also a lot of other things that are for S corps that aren't for C corps. But everything is double taxed because the corporation is going to pay tax, and then you're going to pay tax when you pull it out of the business. And most of those ways, again, unless you're taking it via payroll, there's no way to get it out of that company tax-free.
Mm-hmm. Yeah, and we see this among the companies that we work with that have angel investors or multiple private money investors. They demand that you structure your entity as a C corp in order to take their money, and that is for other reasons that we're not going to get into just for the sake of this conversation. But that's where you see best for big businesses and liability protection. And so, yeah, it's for C corps is for a very specific type of business, when 20 years ago it was pretty much for everybody that didn't want to be a partnership.
Yep. Yeah, you hit it right on the nose. Liability protection is the biggest reason that people want to be a C, or you're massive if you need more than 100 shareholders. That's the other reason to your point, is when you're bringing in investors, you're going to have more, that ideally at some point more than 100. So you either got to be a publicly traded partnership, which a lot of people don't like to do because it's really complicated at that level, ends up being a C corp. So again, sole proprietor, best for you're unsure, you're just starting out. Partnership's going to be best for flexibility and appreciating assets. S corp, best for small business, and it's the most tax preferential way to run your business. And if I have not said it enough, please do not put appreciating assets in a corporation. You will get taxed when it gets pulled out of the corporation. All right, let's move on to talking about S corp elections. We said this earlier. The most common thing I hear is, I made my LLC, so I'm an S corp, right? No. Tim, you want to talk about S corp? You taught me everything I knew about these.
Yeah.
When you recruited me.
Day one. Yep. That's because day one, when I walked into the CPA office in Oregon City we used to work for, the first thing they did is look up 2553 and tell me what it's meant to do. And so it was the first research topic that I got assigned on the job, and it was because of the power that it contains. This 2553 is a very simple form, but this is necessary to make the S corp election. First, you register as a corporation, and then as an S corporation specifically. Don't get confused by what I just said. If you file the 2553 as an LLC, it does both of those steps for you. It makes you a corporation, and then on top of that gives you that S corporation election status. And it's simple. It's a simple form. It just says, what is the name of your business?
To us. You keep saying simple. I've seen these screwed up constantly. Like, please do not fill this out yourself. Go to a licensed professional. I mean, I've done hundreds of these at this point. So for us, Tim, it's very simple, because I could do these in my sleep. But if you've never, the amount of times I've seen S corp elections get rejected, and then I'm redoing it.
Of course. And part of the reason why is because it's very specific about how to make this election. You have to be planning to make this election before you make it, and then make the election. So with an LLC that it's sitting in December, and they want to make this election retroactive to January 1 of that calendar year, it's possible. You can do it, but you would have had to have been planning to be an S corporation all along that year and operating your business as such, meaning you've taken payroll. So that's where you're saying this simple form can get very complicated. And the wording within this form, as it's submitted to the IRS, needs to be very specific. So for us, yes, it's a simple form. Now, it gets very complex depending on your personal situation, and that's where we work with our clients to make sure that the form is filled out correctly. But the reason I call it simple is it is a big change. It's a huge change for your business and for you personally from a tax perspective. But it's just one page. Well, I guess it's two, isn't it? So
2 pages. Come on.
Yeah,
I mean, there's 4 pages to the form, but most of the time you only need 2.
Yeah, we're filling out 2.
It's a 4-page, 2-page, 1-page form.
Yep.
Yeah. The biggest thing too is you're going to get a notice when it's accepted. So if you haven't gotten that notice, it hasn't been accepted, doesn't mean that it won't get accepted. And as you were saying, again, you have 2 months and 15 days from the effective date to make the election, but there is late relief available, and I want to break that down. We've become kind of the kings of that, Tim. Found some tricks. RevProc 23. And as Tim was saying earlier, you must act like an S corp at the time. That means any tax returns that have been filed were filed timely. Now, you said payroll. I don't disagree with you. You should be running payroll. I've seen it a lot where, hey, couldn't figure out how to get payroll. I've been meaning to be an S corp all year. Am I completely screwed? No, that's what you come to us for. As long as we get everything timely filed, we're good. And the ones that will, if you don't run payroll, it won't get rejected. If you don't file your S corp return on time, it will get rejected. If you don't file an extension and then get it done by the extension deadline, it will reject. So if you've never filed an S corp return before, you essentially have until the extension deadline of the following year to make that election, assuming you make an extension. If you don't make the extension, you have till March 15th.
Right.
You can do them late. Now, always make them on time. There's no reason not to. But, we understand the situations. If you see it right there, taxpayer was not made aware of filing requirement of Form 2553 by attorney. It's a very common situation. It happens all the time. I can't tell you how many times I've had a client say to me, hey, our attorney said that we should be an S corp. They said, and then they're like, so we elected to be an S corp. Well, did you fill out Form 2553? No, I wasn't aware of that. Okay, well, and that situation is what stemmed this reasonable cause that I've found has been pretty effective.
And back to what you were saying, we're working with people that have planned to be an S corp, and if it's in July, you made the extension as an S corporation.
Yep.
You filed that extension as an S corporation, even though you haven't filed that 2553. So yeah, it is nuanced and very specific, but when working with us, we'll make sure that you cross your T's and dot your I's.
Yep. All right. Tim, we're about to talk about our favorite person here. Judge Learned Hand. The greatest quote ever for the tax code. Anyone may so arrange his affairs that his taxes shall be as low as possible. He is not bound to choose that pattern which will be best to pay the treasury. There is not even a patriotic duty to increase one's taxes. What does that mean, Tim?
It means the government's stealing from us and we got to fight back.
That's
I'm kidding.
That's not the answer I was fishing for, but
I'm kidding.
I know you had that prepped and ready. It means that you can do things in the most tax preferential way. The IRS cannot come at you and say, hey, well, you should be paying this amount of tax because we want you to. And this is where reasonable comp comes in. And we're going to talk about that. Because as long as you follow the rules, you can do whatever you want that follows the rules. Reasonable compensation, we love this. Distributions and other payments by an S corporation to a corporate officer must be treated as wages to the extent the amounts are reasonable compensation for services rendered. The only other rule is the value that would ordinarily be paid for like services by like enterprises under like circumstances. Okay, so what does that even mean? Who knows, right? I'm a unique person. I'm irreplaceable. So what is my value? Who's going to determine that? There's no way. I mean, and even when you break it down to the value would ordinarily be paid for like services, it's even hard to go there because do you pay me as an office manager? Do you pay me as an accountant? How do you want to value that? And that value is very subjective, and that's where I always see people paying themselves too much. We're seeing it all the time.
All the time.
Where was I going with that? The biggest thing I do see is if you don't pay anything, the IRS has the right to reclassify it. Now, some people have taken that to then like, well, I'll just pay myself 20 grand. Okay, that's a little unreasonable. Can't really base it on that. I would say as long as you're taking payroll, you're going to be in the clear. We have some rules of thumb that we can talk about. But again, from Learned Hand, my interpretation of that is let's at most max out the FICA Medicare maximums.
Right.
And past that, it's not tax preferential. And that's a pretty reasonable basis for me. And given the fact that it's going to be pretty hard, well, one, am I just going to go talk to every accountant around town and see what they're going to be paying for?
Right.
That's the other aspect. The other aspect too is as owners, we want to encourage our business owners to be working on the business, not in the business. And the more passive you can make your activity, obviously, the lower that reasonable compensation amount is going to be.
Yep. And to piggyback on Judge Learned Hand, if it doesn't benefit you, then you don't owe the tax. And that's where we go to the Social Security side of things. We want to max out your Social Security benefit when you turn 64, if you decide to start drawing on it at that time. So that's where we start to talk about with our clients what is reasonable, in the sense of, okay, the intent of what the IRS and the state are trying to do here is to get you to pay into Social Security and Medicare, but they really want to get you in Social Security. So let's maximize your benefit and plan for the future with that, and use that as our basis of reasonable compensation.
Certainly. Now, I want to use a real world example, and I apologize if this makes it political. I don't mean to. Joe Biden, every politician, he just was in the news, and it was the perfect example. They all have speaking engagements. They, have their whatevers, and they obviously run them through the S corp. That's how we know the S corp is not going away. Politicians love these.
Yep.
They're making good use of this tax code. So am I. So Joe Biden, he has his S corp. In 2017, they make $9.5 million. He pays himself $145,833 in wages. In 2018, he makes $3 million, pays himself $300,000. Now I bet that $300,000 is based on the $9.5 million, but I digress.
Sure.
This was super. Like, I remember people blasting him in the news about this, and because they were saying he dodged over $500,000 in payroll taxes. And Tim, when you and I heard that, what was the first thing we said?
He's way overpaid.
That much? Holy cow! He could have saved even more. What is he doing? But that's where you see what he's trying to do is he's maxing out. He goes all the way up to the FICA Social Security limit, where they're not going to. At a certain point, they stop taking Social Security from your taxes, your payroll. He went up all the way to that limit. I've heard that strategy before, because even if it does, then the payroll consequences aren't that big. And I sit there and say, I was like, even then,
right?
Is that reasonable?
Right.
Again, he was blasted over this. The IRS did not challenge this at all. And if you look at those years, it wasn't when he was president. It was when a Republican was president. And I don't say that to make it political. I say that to say, if there was an incentive to send the IRS after a politician, it would have been during a Republican-controlled government on a Democratic candidate. And it wasn't.
Right.
So what is reasonable compensation? And that's where we see a lot of people paying themselves too much. If your business is netting less than 9.5 or 3 million, why are you taking the same amount of payroll as Joe Biden is?
Yep.
That doesn't seem very reasonable to me. And that's where we can get really strategic with reasonable comp. And that's a huge area for tax savings.
Well, and we do have court cases to back our philosophy as well. This is a great example to show, even at the top, this is the loophole that everyone is using. And it's not a loophole. It is just the way that it's structured. And we're going to play the game the same way as everyone else.
Certainly. Well, that is all we have to talk about today. Is there any parting thoughts? I don't see any questions coming through. We'll give people a couple of minutes, but any parting thoughts?
Yeah, absolutely. This is a conversation that just scratches the surface, because it gets so nuanced when it comes to what your personal situation is. And of course, if you're making a bunch of money, we want to make sure that you keep as much of that as possible. And that's where we look at, okay, what is your tax entity? How many owners are involved? Is it a husband and wife? Can we be splitting payroll between the husband and wife instead of just putting it all on the wife? There's so many different things that we could dive into with this. That's where I say, please reach out to us, have a conversation with us, and let us guide you in this. I just set up 2 new entities for a client of ours after having conversations about what the new structure was going to be. What are your plans for this business or these businesses? And now they're on the right foot moving forward. They know they can rest easy knowing that they are set up as the correct entity, and that in the future, if we need to make any changes to that, I'm already prepared with the information. So please reach out to us if you have any questions about this. It's extremely nuanced, but I thought this was a great overview and a great way to really give everybody a little bit of information.
Yeah, I have a couple peeves on reasonable comp of things that I've heard that I want to just kind of end on. A thing I've heard from accountants too is they're like, well, just go look at job listings in the area. I was like, but I mean, which job listings? There's a huge variation. And who's to say, that that's the true, it's not a great metric. And there's, if we're going to look at job listings, can we look at outsourced listings?
Right.
What about the things that I do for marketing? We hired someone else to do those, at a fraction of the price. Does that mean that what I'm doing is less valuable? That's the point with reasonable comp is it's not, you can't always just rely on, well, this is what someone else would pay. And if that was the case, why wouldn't these C Corps could really do some damage to the S Corps by just paying people more and forcing S Corps to pay, you have to pay a huge salary to yourself that you can't afford. The other thing with that, Tim, that we see is a lot of people are paying themselves and then taking a loss on the S Corp. And it's, to that, it makes no sense to me because
none.
At that point, what's reasonable? Because to me, it doesn't seem reasonable that you'd have an employee on staff that is going to drive your business into a loss. That's not reasonable.
Not.
And so they say, even if you want to use the argument of equivalent services, it's like, well, are those equivalent services even ordinary and necessary? The people, I think my rule of thumb is, except for like 3 people that I know that get too aggressive with reasonable comp, people pay themselves too much. And they just do it a lot of times for no good reason, and a lot of times out of fear because they just don't want to, have to worry about it. It's not really, I haven't seen, knock on wood, haven't seen a reasonable comp audit in my life. I've seen, the only ones I've heard of are people, hey, made $1 million, paid myself 20 grand. Yep. You're going to get in trouble for doing that. People that don't take, any payroll for years. Again, yeah, you're going to get in trouble for doing that. But those are really my big peeves on reasonable.
Well, I think your favorite saying, pigs get fed,
hogs get
slaughtered. So that's, it's all about playing the game and paying what you owe, and reasonable comp. It couldn't get more gray. And so,
talk to 5 accountants and you're going to get 5 different answers.
But just understand, we come at it from the perspective of, we want you to pay as little as possible. Keep as much money in your pocket as legally possible. So you're seeing it from that lens in this conversation.
Well, that was a great discussion. We are over time. I don't got any questions coming through, so I'm going to cut us off here, and we will chat with you all next month at the, we'll send out something because we should be the last week still with Thanksgiving. I don't know. Tim, we'll chat about it. You'll see a notice. If you like and subscribe, you'll get notifications when we schedule it. Otherwise, look out for our emails. Chat with you soon.